Gold often moves before fear becomes visible in headlines. Quiet accumulation usually begins when confidence weakens subtly. Stocks may still appear stable on the surface. Divergence signals a shift in underlying sentiment. Recent gold strength reflects uncertainty rather than optimism. Investors turn defensive before risk fully reprices. Defensive moves rarely feel urgent at first. Calm reallocations precede louder market reactions. Stock markets stall when conviction fades without collapsing. Prices drift sideways as buyers hesitate. Hesitation reflects uncertainty about future conditions. Gold benefits from that indecision. Central bank decisions amplify this behavior indirectly. Policy signals create interpretation gaps rather than clarity. Markets react differently based on perceived risk. Gold absorbs uncertainty more efficiently than equities. Inflation expectations play a central role in gold demand. Persistent inflation erodes confidence in purchasing power. Gold represents stability when currency value feels uncertain. That perception strengthens demand during ambiguity. Stocks require growth confidence to advance meaningfully. When growth outlooks become clouded, capital pauses. Paused capital seeks alternatives with perceived safety. Gold becomes a natural destination. Fear trades rarely begin with panic buying. They start with quiet hedging. Hedging feels prudent rather than emotional. Prudence accumulates before fear becomes obvious. Bond markets often confirm gold's message subtly. Yield movements reflect caution about future growth. Caution supports non-yielding assets. Gold thrives when yield confidence weakens. Equity investors tend to underestimate slow shifts in risk appetite. Sudden drops attract attention. Gradual reallocations do not. Gold responds to gradual shifts first. This divergence signals a market reassessing assumptions. Assumptions about inflation, policy, and growth are shifting. Gold reacts faster than narratives. Narratives follow price later. Central bank communication often reduces certainty rather than increasing it. Carefully chosen language leaves room for multiple interpretations. Markets respond by hedging rather than committing. Gold benefits from that hesitation. When interest rate expectations stabilize, but growth doubts remain, equities lose momentum. Valuations depend on future earnings, confidence. Doubt limits upside without forcing collapse. Gold fills the uncertainty gap. Inflation that cools slowly creates mixed signals. Prices stop accelerating but remain elevated. Relief is incomplete. Gold responds to unresolved inflation pressure. Real yields matter more than nominal rates for gold. When inflation-adjusted returns feel constrained, holding cash loses appeal. Gold becomes comparatively attractive. Relative attractiveness drives gradual inflows. Stocks react poorly to policy uncertainty even without negative news. Lack of clarity stalls risk-taking. Investors wait rather than exit aggressively. Gold attracts waiting capital. Gold strength often reflects distrust in policy precision. Markets question whether inflation control will be smooth. Smooth outcomes feel unlikely. Gold prices in policy era risk. Institutional investors rebalance portfolios quietly during these phases. Allocation shifts are incremental, not dramatic. Incremental changes accumulate significance. Gold absorbs institutional caution steadily. Equity volatility staying low can be misleading. Low volatility masks internal repositioning. Defensive assets reveal that repositioning earlier. Gold becomes the visible signal. Currency dynamics also influence gold's rise. A weakening confidence in fiat stability boosts alternative stores of value. Gold remains a traditional choice. Tradition reinforces credibility. The stall in stocks reflects indecision, not strength. Indecision favors assets less dependent on growth narratives. Gold operates outside earnings expectations. That independence becomes valuable. Fear trades rarely announce themselves clearly. They develop through portfolio adjustments that feel logical at the time. Gold purchases appear sensible, not emotional. Emotion enters only after prices move significantly. Equity markets struggle when narratives lose alignment. Growth, inflation, and policy signals point in different directions. Conflicting signals slow decision-making. Gold thrives in narrative confusion. Central banks aim to project control, but markets sense limitations. Policy tools operate with delays and side effects. Uncertainty about effectiveness persists. Gold reflects that doubt. Inflation hedging becomes psychological as much as mathematical. Investors remember purchasing power erosion vividly. Memory influences allocation decisions. Gold benefits from historical association. Stocks discount future conditions aggressively. When future visibility declines, discounting stalls. Flat expectations cap equity advances. Gold does not require optimism to perform. Risk parity and diversified strategies rebalance automatically during uncertainty. Reduced equity exposure increases defensive allocation. Gold receives systematic inflows. Automation reinforces price trends. Fear trade positioning often increases before volatility rises. Markets sense instability before it appears. Gold responds to sensing rather than confirmation. Confirmation arrives later through price swings. Equity investors often expect quick resolution from policymakers. Delays frustrate expectations. Frustration reduces risk appetite. Gold absorbs that frustration. Macroeconomic ambiguity increases correlation risk across assets. Diversification becomes harder. Gold retains low correlation in stress. Low correlation increases its appeal. This phase reflects transition, not collapse. Transitions favor preservation over growth. Preservation assets gain quietly. Gold fits that role precisely. Gold often strengthens when confidence in forecasting weakens. Markets prefer assets that do not depend on precise predictions. Forecast errors become more costly in uncertain environments. Gold benefits from reduced reliance on forecasts. Stock investors look for confirmation before committing capital. Without confirmation, capital remains sidelined. Sidelined capital still seeks protection. Gold attracts that protective allocation. Inflation narratives shift from urgency to persistence over time. Persistent inflation changes behavior gradually. Gradual change favors hedging over speculation. Gold aligns with gradual behavioral shifts. Central bank pauses can be as impactful as rate moves. Pauses signal uncertainty about next steps. Uncertainty elevates defensive positioning. Gold absorbs pause-related caution. Equity leadership narrows during uncertain periods. Fewer stocks drive index stability. Narrow leadership signals fragility. Gold responds to underlying fragility earlier. Fear trades intensify when liquidity conditions tighten subtly. Credit availability influences risk appetite. Reduced liquidity slows equity momentum. Gold reacts positively to tightening signals. Gold demand rises when trust in policy timing erodes. Even correct policy can arrive too late. Timing risk matters to investors. Gold prices in that risk. Stock buybacks slow when management confidence weakens. Reduced buybacks remove equity support. Support loss contributes to market stalling. Gold benefits from shifting corporate behavior. Safe haven demand grows without headlines during early stages. Media attention lags institutional action. Institutional moves shape prices first. Gold reflects institutional positioning quietly. This environment rewards patience over conviction. Conviction requires clarity. Clarity is limited during transitions. Gold thrives in patience-driven markets. Gold also reacts to shifts in global reserve behavior. Central banks diversify quietly during uncertain cycles. Small reallocations compound over time. Gold reflects those slow institutional decisions. Stocks struggle when earnings visibility narrows across sectors. Forecast ranges widen instead of tightening. Wider ranges reduce conviction. Reduced conviction stalls equity advances. Inflation hedging moves beyond commodities into behavior. Households and institutions adjust expectations. Expectation shifts alter capital allocation. Gold benefits from expectation realignment. When rates remain elevated longer than expected, equity risk premiums compress. Compression reduces upside appeal. Investors hesitate to add exposure. Gold absorbs cautious positioning. Geopolitical uncertainty adds another layer to fear trades. Events do not need to escalate dramatically. Persistent tension influences allocation decisions. Gold responds to sustained uncertainty. Gold's role strengthens when correlations rise across assets. Diversification loses effectiveness during stress. Gold maintains separation. Separation increases portfolio value. Equity markets depend on liquidity momentum. Liquidity pauses slow price discovery. Slower discovery favors defensive assets. Gold becomes a liquidity hedge. Fear trades gain traction when downside feels asymmetric. Limited upside contrasts with open-ended risks. Asymmetry favors protection. Gold fits asymmetric protection needs. Long-term investors rebalance rather than trade aggressively. Rebalancing shifts weight toward stability. Stability attracts capital during uncertainty. Gold benefits from rebalancing flows. This phase reflects preparation, not panic. Preparation feels rational and controlled. Controlled behavior accumulates impact. Gold responds before fear becomes visible. Gold benefits when markets question the durability of disinflation trends. Temporary relief does not restore long-term confidence. Investors watch underlying price pressures closely. Lingering doubt sustains defensive demand. Equity markets hesitate when margins face simultaneous cost and rate pressure. Higher financing costs limit expansion flexibility. Margin uncertainty restrains valuations. Gold remains unaffected by margin compression. Policy uncertainty encourages shorter decision horizons for risk assets. Short horizons favor liquidity and safety. Safety-oriented capital avoids long commitments. Gold attracts capital seeking optionality. Gold's strength often coincides with rising demand for portfolio insurance. Insurance demand increases before volatility spikes. Early protection feels prudent. Gold serves as accessible insurance. Stocks react slowly to changing risk distributions. Gradual shifts are harder to price. Mispricing persists during transitions. Gold responds faster to distribution changes. Fear trades also reflect loss of narrative dominance. Bullish stories lose persuasive power. Without narrative support, momentum fades. Gold gains as storytelling weakens. Bond market signals reinforce gold's message subtly. Curve behavior reflects growth skepticism. Skepticism supports defensive assets. Gold aligns with bond caution. Gold demand increases when trust in forecasts erodes broadly. Analysts adjust projections frequently. Frequent adjustment signals uncertainty. Uncertainty fuels hedging behavior. Equity investors often wait for confirmation that never arrives quickly. Waiting creates opportunity cost anxiety. Anxiety encourages partial hedges. Gold absorbs that partial allocation. This stage rewards balance rather than conviction. Extreme positioning feels risky. Balanced portfolios gain appeal. Gold supports balance during ambiguity. Gold often leads when confidence in monetary transmission weakens. Policy changes take time to affect real economies. Delays increase uncertainty about outcomes. Gold prices in those transmission risks early. Equity markets depend on forward guidance credibility. When guidance feels conditional or reversible, confidence erodes. Erosion reduces risk appetite. Gold absorbs that loss of confidence. Inflation expectations anchored above targets sustain defensive positioning. Even modest overshoots alter long-term thinking. Long-term thinking favors stores of value. Gold benefits from extended expectation shifts. Corporate earnings revisions turn cautious before downturns. Caution limits multiple expansion. Without expansion, indices drift. Gold gains as drift replaces momentum. Gold responds positively when real assets regain appeal. Tangible value feels reassuring during policy ambiguity. Reassurance attracts conservative capital. Gold embodies tangible stability. Market participants reassess diversification assumptions during stress. Assets, once uncorrelated, begin moving together. Correlation risk rises. Gold retains diversification benefits. Fear trades intensify when downside scenarios feel plausible. Plausibility changes behavior without panic. Behavior shifts toward protection. Gold captures protective flows. Equity rallies struggle when participation narrows. Narrow participation signals fragility. Fragility invites hedging. Gold responds to fragility signals. Currency volatility adds pressure to equity confidence. Volatile currencies complicate earnings forecasts. Forecast complexity reduces conviction. Gold benefits from currency uncertainty. This period reflects caution embedded across portfolios. Embedded caution moves slowly but persistently. Persistence shapes price trends. Gold reflects that persistence clearly. Gold rallies often complete before stock markets fully react. Early movers hedge quietly while prices remain stable. Stability delays broader recognition. Recognition arrives after gold has already repriced risk. Equity investors often expect clarity to return quickly. Extended uncertainty challenges that expectation. Frustration weakens conviction. Gold benefits from prolonged ambiguity. Fear trades gain strength when downside feels asymmetric. Limited upside contrasts with uncertain risks. Asymmetry shifts behavior toward preservation. Gold aligns with preservation instincts. Central bank credibility remains intact, but constrained. Tools exist. Timing remains uncertain. Uncertainty shapes allocation more than policy intent. Gold prices intent risk, not promises. Inflation that lingers alters long-term planning quietly. Spending, saving, and investing adjust gradually. Gradual shifts accumulate impact. Gold reflects accumulated adjustment. Stocks depend on confidence cycles to advance. Confidence cycles stall during transitions. Stalls redirect capital temporarily. Gold captures redirected flows. Market narratives eventually catch up with price signals. Price leads interpretation. Interpretation follows behavior. Gold leads behavior first. This environment favors assets independent of growth assumptions. Independence reduces forecasting risk. Reduced risk attracts cautious capital. Gold fits that profile naturally. Preparation phases feel calm until outcomes materialize. Calm phases hide repositioning. Repositioning shapes future volatility. Gold reveals preparation early. Gold's strength signals patience replacing optimism. Patience values protection over progress. Protection dominates until clarity returns. Clarity will decide when stocks resume leadership.